So today we are going to discuss the famous FMG stock that is listed on ASX, Australian Stock Exchange. A lot of people in the past years, 10 years and 15 years have been investing safely in FMG because it's a very traditional industry and it gives you dividends, pretty high dividends. It has been giving in the past year or so. The scenario has changed a lot in current times because of US presidential Trump tariffs and a lot of changes, executive changes that have happened in the company itself. But overall, the Fortescue Limited, which is FMG share price, has certainly seen its ups and downs in the last year too, but its reputation for passive income has still remained. A lot of people are still buying it. The volumes are still up high. So this iron ore share usually trade on low price earning PE ratio, which explains the high dividend yield. Providing a generous dividend payout ratio is the main cause for its strong dividend yield. And income seekers would probably like to have a high level of cash flow in their bank accounts each year, which is why safely they're investing in the stock. However, due to the changes that are happening, a lot of analysts are predicting decline in its dividend payments in the near future. A key input for FMG profitability is the iron ore price. Its mining cost don't typically change month to month or even year to year. So changes in how much FMG gets for its production can make a big difference. A rise in revenue can largely add straight onto the net profit, while a reduction in revenue largely dicks its net profit. So the last two dividends from the business total 1.39 per share, and the current share price is translating the dividend yield of 9.3% and a grossed up dividend yield of 13.3%, including the franking credits. Now, what the analysts are predicting is that they're forecasting that the net profit could decrease in fiscal year 25 and it can further drop in fiscal year 26 as well. For example, in the 2025 financial year, Comsec suggested an annual dividend per share of 98.5 cents, which translates into fiscal year 25 fully franked dividend yield of 6.6% and a grossed up dividend yield of 9.5% as opposed to 13% in the previous. So in my view, Fortescue is not a business we can rely on for consistent dividend payments in the near couple of years. However, after falling more than 8% in a month and 32% in a year, I think it's possible the business could provide sizable dividend income for new investors. But the dividends that we were accumulating in the past years, in the past 5 to 10 years, we cannot expect that to get the same dividend anymore in the near future. So that is what my analysis would be in terms of FMG's dividend yield. Obviously, do your own research as to whether you still want to invest in it or not. That would be up to you. Just for knowledge, Fortescue Limited engages in the exploration, development, production, processing and sale of iron ore in Australia, China and internationally. A lot of situation in terms of war is happening all over the world, whether that would put the economy down. If that scenario improves, then maybe the businesses and the economy goes back to its normal developments, especially with the Chinese relationship. If it goes back to normal, then we can see it increasing. But until that scenario doesn't improve, I still believe don't invest too much of your portfolio into the stock. It is a good income stock in terms of dividends, but not as it used to provide us in the past couple of years.